China just told its banks, stop using the US dollar. That one order shook global markets and signaled something bigger. China is no longer listening to the United States, especially not to Donald Trump. After years of being hit with chip bans, export controls, and heavy tariffs, China is done playing defense. Now the fight between these two superpowers is entering a far more dangerous phase. The US isn't just trying to stop Chinese products from entering its market, it's trying to cut China off from the global financial system. Just last month, US officials told the Asian Development Bank to stop giving China loans. They claimed China is no longer a poor country and shouldn't get special treatment. From China's point of view, this isn't just unfair, it's a public insult. Scott Bessent is also telling other countries not to do any business with China.
In Spain made some comments this morning, oh, well, maybe we should align ourselves more with China. That would be cutting your own throat.
And this is only the start. The US is now using its most powerful weapon, the dollar. By controlling access to global money, America is trying to box China in. At the same time, Trump is using the American consumer market to hurt China's exports. Tariffs are still high, around 30%, and on top of that, the US is demanding that China stop producing and start buying more from America. But here's the problem. This strategy might actually be backfiring. Before we get into it, ensure you are subscribed to the channel. First, let's talk about the US attempt to remove China from the Asian Development Bank. The US government recently reactivated the law called the PRC is Not a Developing Country Act, which is a law from 2023, but is now being pushed more than ever. This law tells American diplomats to ask international organizations like the World Bank and the United Nations to stop calling China a developing country. Why does this matter? Countries labeled as developing often receive special benefits. These include cheap loans, longer time to pay them back, and easier trade rules. These perks were meant to help poor or less advanced countries grow. But the US believes China has grown too rich and powerful to qualify for such help anymore. Removing this label would make it harder for China to get cheap international loans and gain special treatment in trade agreements. In other words, the US is trying to limit China's access to global advantages. This isn't just about fairness, it's part of a bigger plan to slow down China's rise as a global superpower. It is not just the Asian Development Bank that the US is trying to force to do its bidding. Scott Bessent is also targeting the IMF and World Bank. US Treasury Secretary Scott Bessent stood in front of international investors and slammed the operations of two of the world's most important financial institutions, the World Bank and the International Monetary Fund, IMF. These aren't just any banks, they're the backbone of the global economy, meant to help poor countries and stabilize markets during crises. And now, the US is basically telling them, follow our rules, or else. Bessent said the IMF and World Bank are falling short. But what does that really mean? It means they're not doing what Washington wants fast enough.
Now it devotes disproportionate time and resources to work on climate change, gender, and social issues. These issues are not the IMF's mission.
The US isn't pulling out of global institutions like the IMF or World Bank, at least not yet. But it's sending a clear message. Follow Washington's lead or get left behind. Bessent delivered that message in polished language, saying, America first does not mean America alone. But beneath the diplomacy, the real agenda was obvious. The US wants these global bodies to operate more like extensions of its own government. And if the World Bank or IMF disagree, they risk losing American support, putting developing nations that rely on them during hard times. But here's what's even more disturbing. Bessent is being undermined by his own boss. Just hours after his speech, President Trump took the stage and threw more fuel on the fire. He made it clear that if America doesn't get what it wants in trade talks, he'll simply slap tariffs on whoever doesn't fall in line. This is not how international leadership works. This is economic bullying. Trump's constant back and forth, announcing tariffs one day, delaying them the next. has caused confusion and chaos. No country or company knows what the US will do next. Investors are nervous, and many billionaires are turning on Trump at this point. Global trade is slowing down, and countries are starting to realize that Washington no longer plays by the same rules it expects others to follow. And here's the big fear. If the US keeps pushing everyone to follow its rules, using institutions like the IMF and World Bank as tools of pressure, other countries might break away completely. They may build their own systems and leave the US behind. Curiously, despite these concerted efforts by the US and its allies, China's global partnerships have not only endured, but have also strengthened. What strategies has China employed to maintain and even expand its international influence amidst such challenges? China has proactively sought to deepen its economic ties with various regions, particularly in Asia and the Middle East. In a significant move, the Qatar Investment Authority acquired a 10% stake in China Asset Management Co., marking a notable investment by a Middle Eastern entity in China's financial sector. Additionally, China's trade with the ASEAN bloc reached $234 billion in the first quarter of 2025, underscoring the region's importance in China's trade strategy. Moreover, China's Belt and Road Initiative, BRI, continues to attract participation from numerous countries, with between 146 and 150 states involved as of 2025. This expansive infrastructure and investment project has solidified China's role as a key player in global development, even as some nations reconsider their involvement due to US pressure. However, the bigger concern for the US could be the industrial capabilities of China. So, how is the US fighting this? That's what we look into next. China is now the most powerful country in the world when it comes to making things. As of 2024, factories and industrial production make up about 26% of China's total economy and account for about 30% of the world's manufactured goods. And that industrial strength sits atop a massive economic engine. In 2025, China's nominal GDP is estimated at $19.2 trillion, making it the second largest economy in the world after the United States. But when measured by purchasing power parity, China's GDP estimated to be $40.7 trillion, placing it as the world's largest economy by real output. That scale gives Beijing not just leverage, but resilience. And while China continues to expand its industrial power, the US is moving in the opposite direction. Manufacturing now makes up only about 10.3% of the American economy, the lowest share since World War II. This decline has left Washington increasingly worried about its long-term economic and national security strength. One big reason for China's rise is a program called Made in China 2025. It started in 2015 and had a clear goal. China wanted to stop focusing on cheap, low-quality goods and instead become a world leader in high technology. The plan focused on areas like airplanes, robots, electric cars, computer chips, and medical equipment. In just a few years, this idea has started to work. For example, China now makes more than 60% of all electric vehicles in the world. It is also the top exporter of solar panels. In 2023 alone, China installed more than 300,000 industrial robots, more than any other country. China has been able to grow so fast because its government supports factories in many ways. These include low-interest loans, government funding, and smart planning. The industrial areas in China are not just full of workers. They are modern centers built around fast transport, organized supply chains, and computer-controlled machines. The United States, even though it has a bigger economy, only makes up about 16% of the goods manufactured globally. This shows how far ahead China has moved. China's success is not just about paying low wages. In fact, factory workers in major Chinese cities now earn about the same as workers in some European countries. What gives China the real advantage is the huge size of its factories, excellent roads and ports, and well-organized systems. In cities like Shenzhen, it is possible to go from a new idea to a working product in just a few days. Most companies in the West cannot move that fast. This situation is making American leaders very worried. They see China's rise as more than just an economic problem. It is also a serious security risk. Manufacturing is important for military strength and for making things like computer chips and advanced machines. That is why President Donald Trump has taken strong action. He raised tariffs on Chinese goods as high as 245%. He also gave money to companies that bring factories back to America. These moves are meant to slow down China's progress. But these actions have not stopped China. Even with the restrictions, Chinese companies are still growing. For example, Huawei has started making advanced computer chips inside China, even after the United States tried to stop it. Another Chinese company, BYD, is now selling more electric cars than Tesla. It is also opening new markets in Europe, South America, and Asia. This makes people in the United States ask some hard questions. Can America really separate its economy from China? There is something even more serious to think about. If China continues to grow this way, it will not just control factories. It will also begin to control the rules of global trade, business, and technology. That is the outcome the United States fears the most. The US is trying to protect itself with a strategy some call Fortress America. This means building economic walls, adding tariffs, limiting trade with China, and creating exclusive trade clubs with close allies. The idea is to keep China out of global supply chains and reduce its influence. But here's the problem. America's allies depend on China. For example, German car companies rely on Chinese-made parts. Japan's electronics firms depend on Chinese factories. These deep economic ties make it hard to fully separate from China. China's exports, especially to countries outside the US, continue to grow. In 2024, China exported goods worth nearly $3.6 trillion, with a massive trade surplus of almost $1 trillion. This proves that China is deeply embedded in the global economy. America hopes that isolating China from global trade and finance will weaken it. But this strategy might have some unintended consequences. If China is blocked from using US-led financial systems, it might create its own financial network. In fact, China's Belt and Road Initiative is already building new trade routes and lending systems across Asia, Africa, and Latin America, without needing the West. History shows that when a powerful country is economically cornered, it may become more aggressive to protect its interests. Some experts worry that this economic conflict between the US and China could lead to increased tension or even military conflict in the future. Now the battlefield shifts to the currency. Beijing is actively pushing to replace the US dollar in its international trade settlements. In a major policy move, the People's Bank of China recently raised the minimum threshold for yuan-denominated trade transactions from 25% to 40%. This isn't just a suggestion, it's a strategic directive woven into China's broader economic and geopolitical playbook. In 2024, China's total trade in goods reached 43.8 trillion yuan, or about $7.8 trillion. Currently, only 30% of that trade is settled in yuan. But if banks meet the new 40% target, over $3 trillion in annual trade would bypass the dollar system entirely. That's not a symbolic shift, that's tectonic. It would weaken the dollar's dominance, boost global demand for the yuan, and draw capital toward Chinese financial markets. The People's Bank of China, PBOC, isn't offering guidance. It's issuing marching orders. And the impact is immediate. As more trade flows through yuan, China becomes less exposed to dollar-based sanctions and more attractive to foreign investors. Goldman Sachs estimates that a 1% rise in the yuan could lift Chinese stocks by 3%. This is a zero-sum game. Every dollar flowing into China is a dollar not flowing into US bonds or stocks. And this is only the beginning. If even a fraction of the remaining $4+ trillion in trade still conducted in foreign currencies converts to yuan, China's financial ecosystem could evolve into a global capital magnet, reshaping investment flows and undermining the foundations of US asset markets. Let's end with something electric. Literally. Chinese EV titan BYD is igniting a price war with massive 10% to 30% discounts on its already affordable vehicles. For Elon Musk's Tesla, this is a nightmare. In markets from Europe to Southeast Asia, BYD's aggressive pricing threatens to squeeze Tesla's margins and market share. But this isn't just about cars. It's about the battle for dominance in future tech. Chinese companies, armed with low costs and state-backed industrial policy, are preparing to wage war in every corner of the globe, from auto exports to AI chips. And guess what? They're just warming up. From trade to currency, from manufacturing to capital flows, China is launching a full-spectrum economic counteroffensive. And this isn't just a shield against US pressure. It's a blueprint for a new global system. Disruptive, strategic, and fast-moving, Beijing's plan is reshaping the rules of the game. The real question isn't whether China can survive America's pressure. It's whether the rest of the world is ready to follow China into a new economic order and leave the old one behind. If you found this breakdown insightful, make sure to subscribe and turn on notifications. Thanks for watching, and see you in the next video.